the investment decision-making process. So our ultimate goal is to make an investment decision. We build pitch books or we make other materials. It can be called teasers, it can be called information memorandums, whatever you call it. There's gonna be materials, PowerPoint slides or Word documents that support investment decisions. And investment recommendations that are usually included in pitch books or other materials are going to be based on valuation, such as discounted cash flow analysis, trading comps analysis, transaction comps analysis, LBOs, so many valuation methodologies that we're going to learn in the future. But anyways, through these valuation techniques, we can draw up a investment recommendation, which leads to investment decisions. However, if you want to do proper valuations, in most cases, we need financial projections. What are the revenues going to be in the next 5 years? What's going to be the operating expenses in the next 5 years? The balance sheet, the free cash flow, and so on. And in order to do a thorough projection of the financial statements, we have to analyze the past and also the present as well. So we're going to do a 3-statement modeling. It's the forecast of the income statement, balance sheet, and the cash flow statement. So in our offline classes, I often ask students, this is also a very, very popular technical interview question for investment banks or private equity firms or asset management firms. What do you think is the single most important line out of these 3 statements? When I ask this question, of course, it doesn't really have a correct answer. It depends largely by individual industry. It depends by situation. But when I ask this question to a lot of students, I think 70% chooses operating profit or net income. Around 20%, I think they choose free cash flow or something from the cash flow statement. And 1 out of 10 students, they choose total assets or some items from the balance sheet. There's no correct answer. Whatever you choose, if you have the right reasons, that should be justifiable. But personally, if I was the candidate of the interview, I would have to choose operating profit, EBIT. The main reason is that operating profit becomes the starting point of most valuation methodologies. So if you're trying to make a DCF analysis, we have to calculate free cash flow, and there are a lot of formulas that start calculating free cash flow, but in most times it starts from operating profit. Also, if you want to do a valuation on multiples, price to earnings multiples and EV/EBITDA multiples are the most frequently used multiples, and I would have to say EV/EBITDA multiples are more likely to be used recently, especially if you're valuing for gross equities or equities that does not produce net income yet. So I would choose operating profit. There's no correct answer. That's just my personal opinion. But when it comes to financial modeling and when it comes to restatement modeling, we do have something that's most important. And I stress this out to students as frequently as possible. Revenue. It's all about revenue. Top line, the estimates are most important. And here's the reason why. When we're doing financial modeling, we're going to estimate revenue first. And the reason why we do that is most of the forecasts for operating expenses or forecasts for the balance sheet or the cash flow statement, they're going to be based on revenue. So it's going to have a logic something like this. For example, if we want to forecast marketing expenses, we expect revenue to grow 3 times in the next 5 years. So generally marketing expenses would have to follow revenue because it's considered a variable expense. So if revenue jumps up by 3 times, marketing expenses should also jump up 3 times. And that is going to be our most basic logic. Same goes for capital expenditures, depreciation. So many items are going to depend on our revenue forecasts. So in the end, how we forecast revenue is going to impact the number 2 and number 3 areas on our PowerPoint slide. And later on, it's going to impact our free cash flow. It's going to impact our DCF analysis or other analyses on valuations. So it is going to basically determine the corporate value. So in many M&A cases, or if you have a very important investment decision to make, revenue estimates or operating profit estimates are outsourced to strategy consulting firms such as McKinsey, Bain, or BCG. It is often called commercial due diligence, and they would be assigned to a project to forecast only revenue. So they're given time like 4 weeks, 3 weeks, 5 weeks of time, and all they have to do is to forecast revenue, but it's going to require a lot of analysis. They have to analyze the industry, they are going to analyze competition, they'll use all their resources, their human resources or networks or everything in order to estimate, do their best on estimating revenue. Therefore, in our Financial Modeling 101 course, and also in our courses that may contain case studies in the future, we're going to spend a lot of time on forecasting revenue, and then the number 2 area. So forecasting operating expenses, also very important. But number 3 area, it's going to be relatively light. Of course, there are companies or industries where these items might be very, very important, but at least for now, we're going to keep it as simple as possible in our 101 class. And as you all probably already know, these 3 statements are always interconnected, very complicated. So usually a change in a certain account is going to affect another account in a different statement. So it is very important to know how they are connected and understand the consequences of various events. Let's see just one example. For example, property, plant, and equipment items are going to be closely related to capital expenditures on the cash flow statement and depreciation on the cash flow statement, which is also going to be allocated to cost of goods sold and selling, general, and administration expenses. So our task is to understand these relations and try to make them mechanically work on Microsoft Excel. It sounds tricky, but if we do it just one by one, I'm sure that most of you won't have too much difficulties in building these three statement models, and it comes from experience. We have taught over 1,000 students up to now in our offline courses.